Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous?
Glad you're here. Welcome to Modern Investing Techniques, episode 71. Today is June 9th, 2026. I'm Patrick, broadcasting from Vancouver. Today's markets have some interesting setups. Let's break them down. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. Canadian investors holding housing-related assets should reassess exposure after insolvency volumes hit their highest level since 2009. Markets closed higher today despite mixed macro signals. The S&P 500 finished at 7,406, up 0.3%. The NASDAQ Composite closed at 25,930, up 0.9%. The TSX Composite ended at 34,479, up 0.2%. Moody's recession warning and May CPI pressures are creating caution around consumer and housing exposure. Canadian investors are being flagged to reassess housing-related assets after record insolvencies since 2009. Portfolio cumulative returns and alpha versus the NASDAQ are unavailable in today's tracker data. China's planned $295 billion data center build-out over 5 years creates a long-cycle infrastructure theme. This spending extends beyond single-stock AI exposure. The commitment rewards investors who focus on companies supplying power, cooling, and networking equipment. Avoid chasing headline chip names in this setup. Pair the approach with volume confirmation above the 20-day average to avoid early fades seen in prior rotations. Canadian investors can access this through global infrastructure ETFs, or individual names with verified supply chain exposure. Stay inside TF's A contribution limits while doing so. Historical parallels show these build-outs deliver the strongest returns in years 2 through 4 once initial capex peaks. Risks include sudden export control tightening from Taiwan that could disrupt component flows. Now consider how this long cycle idea contrasts with real estate exposure many Canadians already hold. Imagine you allocated $50,000 from your TFSA into a rental property in a mid-sized Canadian city last year. You expected steady cash flow, but the mortgage payment and maintenance quickly consumed most of the rental income. Capital gains tax treatment on any eventual sale still applies at the new inclusion rate. Publicly traded REITs, such as RioCan or Canadian Apartment REIT, offer the same real estate exposure. They provide daily liquidity and no property management burden. Their distributions are taxed as ordinary income inside non-registered accounts. Mortgage investment corporations provide higher yields through private lending. They carry credit risk that is harder to diversify than a broad REIT ETF. The BRRRR strategy can be adapted for Canadian markets by using a HELOC on an existing property. Yet it triggers superficial loss rules if you repurchase the same asset within 30 days. Professionals always compare after-tax internal rates of return across REITs, MICs, and direct ownership before committing capital. The biggest mistake with real estate allocation is assuming direct ownership always outperforms liquid alternatives. Always model the full tax and effort cost of each vehicle before choosing. For the practice investment of the day, we are skipping a new position. No qualifying setup meets both fundamental catalyst and volume spike criteria outside the warned sectors. We are watching consumer and financials names for RSI below 40 on daily charts with rising volume. Sector concentration limits and cool-down rules prevent entry until fresh data appears. Skipping a trade when criteria are not met preserves capital. This reinforces the discipline of waiting for confirmed setups. It directly counters the pattern of entering without volume confirmation that produced prior fades. Listeners learn that the best trade is often the one not taken when macro headwinds remain elevated. This is a simulated trade for educational purposes only. Yesterday's weekly hold was NVO on a catalyst entry for the first global launch of oral Wegovy outside the US. We simulated buying at $45.39 on Monday's open. We exited at $43.75 on Friday's close. The position lost 3.61% or $36.13 on a $1,000 simulated stake. The catalyst entry produced a loss once broader market volatility increased without supporting volume. This is the exact scenario where our earlier rule about volume confirmation would have helped. The new rule requires both a fundamental catalyst and a volume spike above the 20-day average before committing capital to healthcare launches. Bloomberg Terminal Lite via public X feeds lets investors monitor real-time policy and spending announcements. Follow verified accounts that surface Bloomberg headlines within minutes of release. This gives retail traders the same headline flow previously limited to institutional desks without paying terminal fees. Set notifications for keywords such as data center or export controls to surface opportunities ahead of broader market reaction. Moody's economist flags recession risk with weakening consumer finances and rising insolvencies that could pressure cyclical sectors. Hold CAD cash allocation at current levels and avoid adding new cyclical exposure until the next CPI print. Airline ticket prices rose more than 20% year over year. Higher travel costs add to household budget pressure already visible in 57% of consumers citing price strain. Trim any consumer discretionary ETF holdings showing negative relative strength versus the TSX. Taiwan weighs tighter AI chip export rules that could slow component flows into China's data center buildout. Add names with diversified non-China supply chains to the watch list for potential rotation. Construction material costs worsen U.S. housing affordability and extend the timeline for any housing market recovery. Avoid adding Canadian home builder or REIT exposure this week, pending clearer volume signals. The simulated portfolio has completed 33 trades. The win rate stands at 58% with 19 wins, 11 losses, and 3 break-evens. Cumulative P&L figures and average return per trade are unavailable in the current tracker output. The best trade reached 20.11%, while the worst reached negative 11.35%. The current streak is 1 loss. Our AI analysis is learning from volume confirmation patterns and adjusting entry discipline accordingly. Before we wrap, open your brokerage screener and filter for consumer sector names with 14-day RSI below 40. Note any that also show volume above their 20-day average. Mark the top 3 for further review before Friday's close. Watch for volume-confirmed setups in infrastructure names ahead of next week's open. That wraps up today's modern investing techniques. Remember, every trade is a learning opportunity, win or lose. Subscribe, share with a friend who wants to invest smarter, and we'll see you tomorrow. And before you go, this show is part of the NARA Network, a family of daily podcasts covering tech, science, markets, and more. If you enjoyed today's episode, give Unintended Consequences a listen. True stories of good intentions that backfired. You can explore the whole lineup at neuranetwork.com. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking about